This video is brought to you by togetherbudget.com. Welcome to the world of dividend growth investing, where you can earn consistent income from high-quality companies that consistently increase their dividend payments. Dividend growth investing involves selecting companies with a proven track record of paying consistent dividends, and then holding on to them for the long term to benefit from their rising dividend payments. By focusing on companies with a history of dividend growth, you can create a portfolio that generates increasing income over time, providing a reliable source of returns and reducing the impact of market volatility. Dividend growth investing is not just about earning passive income, but also about participating in the long-term success of high-quality companies that consistently deliver value to their shareholders. Dividend growth investing offers a unique combination of income generation, capital appreciation, and reduced volatility. By focusing on companies with a proven track record of dividend growth, investors can tap into a steady stream of returns. Investors in dividend-paying stocks have historically outperformed the broader market, particularly during times of economic stress. This is because companies with consistent dividend payments tend to be more financially stable and better equipped to weather downturns. One of the key benefits of dividend growth investing is its ability to generate income without relying on complex strategies or leverage. By focusing on established companies with a history of dividend growth, investors can create a diversified portfolio that provides regular returns. In addition to its income-generating potential, dividend growth investing also offers the opportunity for long-term capital appreciation. As companies continue to grow and increase their dividend payments, investors can benefit from rising share prices. Welcome to the world of dividend growth investing. In this section, we'll be discussing the crucial step of stock selection for DGI. This involves identifying high-quality companies with a proven track record of paying consistent dividends. When selecting stocks for DGI, we need to consider factors that ensure a long-term sustainability. This includes assessing the company's financial leverage, interest coverage, and free cash flow generation. In addition to financial metrics, we should also consider non-financial factors that can impact a company's dividend sustainability. This includes assessing its management team, corporate governance, and social responsibility. Ultimately, stock selection for DGI involves a combination of financial analysis, industry research, and non-financial due diligence. By following these steps, you can increase your chances of selecting high-quality dividend-paying stocks with strong, long-term growth prospects. When evaluating dividend stocks, investors often compare two key metrics: dividend yield and dividend growth. While yield provides a snapshot of current income, growth represents future potential. Consider a stock with a high yield but stagnant growth. In this scenario, investors might prioritize DG over DE, recognizing that future income will be crucial for long-term success. On the other hand, some investors might value stability and current income more than future potential. In this case, DI could be the primary consideration. Ultimately, both DI and DG have their uses. A balanced approach that considers multiple factors will help investors make more informed decisions about their dividend portfolios. Rising dividends are a key indicator that a company's financial health is improving. When a company increases its dividend payout, it shows that the business is generating more cash and has excess funds to distribute to shareholders. Investors seeking dividend growth look for companies with a history of increasing their payouts. A consistent rise in dividends demonstrates the company's commitment to rewarding shareholders while also investing in its business. While rising dividends are generally a positive indicator, it's essential for investors to evaluate the underlying reasons behind the increase. Is the dividend hike driven by improved profitability, or merely a one-time adjustment? To incorporate rising dividends into your investment strategy, focus on companies with a proven track record of increasing their payouts. Look for those that demonstrate consistent growth and a strong balance sheet. Tax efficiency is a crucial aspect of dividend growth investing. As a dividend investor, you need to be aware that the taxes on your dividends can significantly impact your returns. Tax-efficient investing is a strategy that focuses on minimizing the impact of taxes on your investments. By adopting this approach, you can maximize your returns and achieve long-term financial goals. Tax efficiency is not just about minimizing taxes, it's also about maximizing after-tax returns. By making informed investment decisions, you can create a more sustainable and resilient dividend growth portfolio. Tax efficiency in DGI portfolios requires patience and discipline. By understanding how taxes affect your investments and making informed decisions, you can create a more tax-efficient portfolio that generates sustainable returns. As a dividend growth investor, it's essential to understand the concept of risk management and volatility. Risk management is about identifying and mitigating potential risks that can impact your investments. Volatility refers to the fluctuations in stock prices. One way to manage risk is by diversifying your portfolio. This involves spreading your investments across different asset classes, sectors, and geographic regions. By doing so, you can reduce the impact of any one investment's volatility on your overall portfolio. Another aspect of risk management is understanding the company's financial health. A strong balance sheet, stable cash flow, and a proven track record of dividend payments can help reduce your exposure to potential risks. Finally, it's crucial to set a stop-loss order, which automatically sells your stock if it falls below a certain price. This helps limit potential losses and maintain discipline in your investment strategy. Meet Warren Buffett, a legendary investor who built his fortune by investing in dividend-paying stocks. He famously said, "Price is what you pay. Value is what you get." By focusing on undervalued companies with strong dividend yields and growth potential, Buffett created a portfolio that generated significant returns over time. Jenny Johnson, a self-taught investor, used DGI to grow her portfolio from $10,000 to over $100,000 in just 5 years. She attributes her success to a disciplined approach and careful stock selection. By choosing companies with consistent dividend payments and growth prospects, Jenny was able to ride the ups and downs of the market. David Booth, co-founder of Dimensional Fund Advisors, has built a reputation as one of the most successful investors in history. He emphasizes the importance of smart beta investing, which involves using dividend yields and growth rates to identify undervalued companies. By focusing on these metrics, David was able to create a portfolio that outperformed the market over time. Meet Margaret Nelson, a retired school teacher who turned her retirement savings into a lucrative investment portfolio. By focusing on high-quality dividend-paying stocks and riding out market fluctuations, Margaret was able to achieve significant returns over the long term. She attributes her success to patience and discipline in her investment approach.